And we're live.
Hey, buddy.
Hey,
How
man.
you doing?
How's it? Good. How are you?
I'm good. Yeah,
Uh,
looking forward to the same rituals, and we're live.
And
Okay.
we're
Yeah,
live.
it's Sunday. It's 7:30 if you're in the Pacific, and thank goodness it's not quite that early if you're in the UK. But
Yeah,
it's
exactly.
yeah, looking forward to our topic as ever. So yeah, got some exciting, juicy microeconomic stuff in our first principles series, which I'm really enjoying. I have to say, I'm such a nerd, but I just am. I really love it. I think there's so much power as well. I love it when intellectually interesting meets really bros of business. That's my favorite intersection of things.
Business bros. Is that what you just said? Are we business bros?
No, no, no. I said I love it when intellectual concepts overlaps with business growth. Sorry, I
Oh,
obviously need to put my teeth in. Business bros. That's a very American kind of
called
branding.
us a
Business
business bro.
bros.
Oh, man. Well, if you're watching with us live, good morning. Hello. We are going to do our podcast recording. So welcome, welcome, welcome. Give us a like, love, comment, or share. Say hello in the comments wherever you're watching this. We're going to start our podcast in just a minute. And we will kick things off. Today's topic is cash flow, all things cash flow. And you've got an awesome three-part system or model that you're going to walk us through in this episode. And that's going to be really, really helpful. So if you struggle with keeping your cash flow in your checking account or your checking account balance over zero, above zero, then you want to pay attention to this episode and dive into it with us. So,
Absolutely.
yeah, good times, good times. Really, really looking forward to this one. We'll just tune things up here. And if you're watching with us, say hello. And we'll kick things off in just a minute. All right, here we go. Yeah. If you're just joining us, I just keep watching people popping in here. So if you're just joining us, give us a like, love, or comment. Let us know where you're watching from. We're going to start our podcast in just a minute. Sorry to repeat myself if you've been listening for the last 2 minutes, but we are going to start in just a moment talking all about cash flow. 3 dynamic principles for managing cash flow is our topic for the day. So, Michael, are you ready to do this?
Absolutely. Yeah.
All right, let's kick it off. I am ready. Here we go. Shall we do this? You ready?
Yep. Yeah. Yep.
All right, podcast
Go.
time. All right, let's do it. They say cash flow is the lifeblood. Yeah, I'm going to do that over for
They
the
do.
posterity.
I never heard
do.
that. I didn't know they said that.
I'm trying to fancy one today. Hey, give me a break, man. Here we go. They say cash flow is the lifeblood of any small business. I don't know who they are, but they sound pretty smart to me. In this episode, we're going to dive into the topic of cash flow secrets, maybe, best practices for sure. So if you struggle to keep your checking account balance in a positive territory, this episode is for you. Say goodbye to NSF, non-sufficient funds notices, and join small business moguls who have learned to master cash flow. How do you like that introduction, Michael?
I love it. By the way, I love the reference to they, the generic they, know something pretty smart. So yeah, I love it. Good fun. And it's good to take microeconomics, which sounds very dry as dust and something you did in college just to get your degree in order to escape, and the real life, fight to the death, or at least it feels like that is e-commerce, real life stuff that puts money into your pocket and food on your table for your family, or doesn't. But actually, I think there is way more overlap between the right concept and real life than we as business operators tend to give credit for. And this is why I love this microeconomics and first principles thrust and whole category that we're doing. So that's part of that for me. So I think cash flow is critical. If you get this wrong, then you're going to have not enough cash, which is really distressing. That could be the end of your business, and that happens sadly quite often. Bankruptcy can happen even if your profits look good. Cash is not the same as profit, famously, but particularly during e-commerce. If you don't know your numbers, you're driving blind, very dangerous. And if you have really low profits, your business value, even if it survives, is going to be fairly low, and you can't pay yourself very much. So get this right, and you will know your numbers, which means you feel more secure and it's more sellable, You'll have higher profits, which makes your business more valuable, and you'll have plenty of cash, which is reassuring and means that your business is safe. So I think it's the secret to both safety and scaling, and that's why I'm so passionate about this.
Yeah, love it.
That's my main take on it.
I want to just also mention that we're talking about small business cash flow as well, not just e-commerce specifically in this episode. And I just want to say one little shout out. It's still COVID lockdown to some degree here, so I've continued to watch everything possible on both Amazon Prime, Netflix, and Hulu, and every other streaming service. And my latest show I'm binging is called The Farming Life from BBC. I get it on BritBox on Amazon Prime, and it's all about British sheep farmers. Have you seen that show, Michael? Is that
I have
popular
not
in
seen.
Britain?
I have no idea whether British sheep farmers are popular in Britain. I can't imagine that they necessarily are, but I have no idea.
It's a really fun show, and let me just tell you that in the episodes that I'm watching, they're just a year ago, so they're struggling with COVID hitting them, and they're all in lockdown, and all the farmers are all holding inventory they can't sell, and their cash flow is all. I mean, they live, almost like month to month, hand to mouth. What they can sell, they survive on. And so, and I was watching the episode last night. And these guys are in a cash flow pinch in their businesses. So all that to say, this is transcendent. It goes well beyond just e-commerce, Amazon sellers. There are many people who are working in businesses who need to manage cash flow effectively. And I think this topic will be very helpful for them as well.
Very, very, very true. And I think you're right. Anyone who holds inventory, basically, whether that be in the form of a cow or a sheep or a plastic widget from China, really has to manage cash flow in a way that somebody's a service-based business or with digital type products like yourselves hasn't got quite the same pressure on them. So yeah, COVID is really killing a lot of people in the cash flow right now. You're 100% right.
Yeah. So let's dive into this topic. What are the specific terms we should define here? So what are the actual details of when you say cash flow management? What exactly are you talking about?
Good question. Well, so let me just give the sort of bigger picture context first, and then we can sort of argue about how many angels dance on the head of a pin, because there's going to be some more accounting type approach. I'm not suggesting anything scientific in this, more grasping the concept and making it almost physical for me. That's when it starts to affect how we run a business. So for me, it's like the movement of cash in a business is like the movement of fuel in a combustion engine, and cash is the fuel that makes the entire thing work. So for me, the primary piston movement of our business in the internal combustion analogy is really the conversion of cash into stock through the magic of sales, that spark that means a person goes click and adds it to cart, and click actually pays, and then back into cash at that point. And as long as more cash is produced than is used up, like a sort of chemical reaction equation, then our business moves forward, just like with an engine. As long as the energy given out by the sales reaction is greater than the energy used, that spare energy can be used to move the vehicle forwards, if you like to use the analogy. So if that's then intelligently applied through the drivetrain, which for me would be the things that gets to the wheels, the vehicle moves forward. So for me, the cash flow of a business is right at the heart of the business engine, if you will. And to reference something we talked about last time, or recently, we talked about Jim Collins's flywheel concept, which is obviously a literal thing, as you pointed out, in the engine of a car that kind of captures the energy of the pistons and the crankshaft and turns it into smooth motion. So for me, the cash flow, and especially the cash conversion cycle of a business, converting cash into stock into cash effectively for us in our business model, e-commerce. So that cash conversion cycle is really intimately connected with that flywheel concept. So for me, if the conversion of cash into stock and stock into cash is at the heart of the engine, then the flywheel that matters most in e-commerce, in my opinion, is the one that converts cash to stock and stock to cash. That's the one flywheel that if we get working, everything else has a chance to work. And if that's dead, the whole business is dead, in my opinion.
Okay, sure. Love it. Wonderful. Okay, so obviously it's a big topic. And there's a lot of moving parts here, to use your engine metaphor. So let's break it down. Now you've got a model that's like a 3-part, kind of concept. So let's dive into that a little bit. What do you think the 3 critical aspects are? And should we break them down one at a time? What do you want to do?
Yeah, let's take them one at a time. So I think that the 3 problems as they show up is you don't know your numbers. You have low profits, and you don't have enough cash in your account at the end of each month, quarter, or year.
Okay, so the first problem, you don't know your numbers. let's dive into that. I mean, I think to put my own point of view on it, you know, cash flow is a two-edged sword, isn't it? Sometimes actually it's best to have problems with cash flow because it actually forces you to get really, really clear on your numbers. Sometimes actually, abundance of cash flow allows you to be sloppier than you should be. And it's human nature as small business operators to just focus on problem solving. And if cash flow isn't a problem, then you don't have to go in and grind it out and actually know your numbers. And so I think it's one of the ironies of it actually, is that being lean forces you to have good discipline.
Yeah.
But talk more about not knowing your numbers. What's the solution, and what are your thoughts on it?
Well, to your point, they say that wisdom comes from experience, and experience comes from taking action based on bad judgment. So maybe what you're saying is that you have to experience some pain before you start taking it seriously, and that's probably true. So I suppose you can sort of flag this up as an issue, but it's only a theory until you've experienced not being able to meet payroll, and then suddenly you're going to take it seriously. You're absolutely right. So yeah, why do you need to know your numbers? I guess what you've just said is really if it feels like you don't need to know them, maybe that's true for now. But if you keep growing, there's a famous phrase, Vern Harnish articulated it, of the Rockefeller Habits fame, and he said, growth sucks cash. So if you have abundant cash flow, you're either not growing, or if you have it now, but you start growing aggressively on the basis of it, sooner or later you will have cash flow problems. And then, as you say, you'll be forced to sort it out. So the solution to not knowing your numbers is kind of head slapping the obvious in a way. Know your numbers or get accurate accounting. But that's obviously an easy thing to say. Let's break it down into, I think, 3 areas, and then happy to discuss any of those and see what your opinion is, of course. So I think the first thing is to get a chart of accounts, which is that magic way of doing things, which doesn't feel very magic, by the way. And I would definitely get an accounting professional involved in this. But really, what it means is it converts the individual transactions that happen in your business and puts them into the right place in your accounting. So does it affect your balance sheet? Does it affect your profit and loss? That kind of thing. And I think until that's set up, you really cannot have your accurate 3, really core financial documents, which is to say your profit and loss account, of course, which most people are familiar with at some level, but they get very confused between that and the cash flow. And the missing piece is the balance sheet. So you really have to have, I think, those 3 documents for any business that has any kind of ambition to scale, let alone is at quite a scale already. That is to say, profit and loss, balance sheet, and cash flow statement. And if you haven't got a chart of accounts, then you can't really translate the day-to-day operations into those 3 documents, and you're driving blind.
Yeah, great point. I mean, I guess in our practice, I think probably how that came together was that organically occurred as we tried to get our profit and loss statement sorted out. So the profit and loss statement was the prize, I guess you could say, and the chart of accounts process was just to get the clarity that we needed to get there. And in our business, we've always focused on the P&L more. And honestly, I suppose in my coaching client, I always push people to focus on their profit and loss statement. But to your point, cash flow, statement cash flows, and balance sheet, of course, important as well. But the P&L, I think, is infinitely helpful as a month-by-month tool and quarter-by-quarter tool to go back and say, where exactly are we spending a lot of money, and what actually fell to the bottom line net profit that we can say, hey, this is what we're actually pulling out of the business and living on, or whatever. So to me, the P&L is really the instrument of optimal management, I think, in my opinion, for small business operators, or at least a first great tool.
Yeah, it's an interesting statement. I mean, I'm going to talk about that under the 3rd problem. I've got some things to say about the balance sheet management, which I think is a neglected area, and therefore for a lot of people relatively easy wins, actually, because a lot of us are okay. If you don't know what's going on at all, not knowing any numbers, of course that's disastrous, and it's easy enough to do. As you say, knowing your profit and loss well is really a great idea. We don't, yes, as the first starting point, I would say that the balance sheet, there's power in that, and we'll talk about that in a minute. I think
let's keep going on this one though. I don't want to move on to the next problem yet because I have a few other points. Sorry, I didn't mean to interrupt, but keep going. Yeah.
Yeah, let's get a couple of things out, and then let's talk about
Okay.
this, because obviously, knowing your numbers accurately accounted, this is like a micro. This is like an overview of a lot of things which,
Mhm.
in themselves, we
Yeah.
may need to deep dive into in other episodes, I think. So the second thing is integrating your bookkeeping and platform. So
Sure.
this is more of a sort of SaaS or mechanics about it, but I think it is important if you're going to have lots and lots of transactions happening on the platforms, Amazon, Shopify, wherever else, on the
Yeah.
one hand, and then on the other hand, you've got a chart of accounts that kind of tries to neatly turn those into the three financial statements, then you've got to actually make that happen in practice in a slick way. Otherwise, you're going to have your chart of accounts here sitting there lonely, a bunch of transactions happening here, and
Yeah.
you theoretically intend to put them together, but you never get round to it because you're busy running your business. And so I think it's really important to either use SaaS or software and or people that are very dedicated to that. So I would say if you're looking for integrating Xero or QuickBooks into Amazon, Link My Books is the best software for that, which I happen to know the guys who set it up. Some British guys. One's
Oh,
called
wow.
Swedish Dan and lives in Sweden, and the other one, Pete, actually lives in Australia. So they're Brits abroad, but they're very, very
Mhm.
smart guys. They know Amazon really well. One of them's got a huge programming background, so that is really the one that I would recommend. Another one that you could use is Xero, I think it's A2X, which links Amazon to Xero,
Okay.
and I'm sure there are Shopify equivalents. But that's a practical piece where you're articulating this theoretical good to do into actually doing it.
Link My Books. That's
Mm-hmm.
interesting. Okay, because yeah, I was going to ask you kind of what your recommendations were in our business experience, and what we can, always encourage people to get into is QuickBooks Online. We started with QuickBooks in the offline version, and we were on that for a long time, and finally had to make this transition to QuickBooks Online. But yeah, that's the tool of choice for us. Link My
Absolutely, yeah.
Books sounds like an interesting, tool to help put it all together as well.
Exactly. I think it. I mean, I suppose that the tool for the chart of accounts is really QuickBooks, which will
Mhm.
automatically,
Yeah,
once you've created a chart of accounts, will start to turn your daily journal transactions into, put it into the
sorted.
right place and sort
Yeah,
it into the profit and loss, the balance sheet, the cash flow statement, and so forth, and indeed other things if you want them, other reports if you want to get clever.
yeah,
And yeah, QuickBooks is great. Xero, Xero is also one that I've used personally and works pretty well. So I think, to be honest, and we're talking already about software, but also people interact with software.
yeah.
For me personally, I would say if your accountant that you know knows your business model and understands your business wants to use QuickBooks, then use QuickBooks. And if they want to use Xero, then use Xero, because
Mhm.
there's nothing worse than a conflict between
Yeah,
an otherwise very, very capable professional and they're fighting with your software.
right.
This is, in my opinion, not the way to do it. Or you could put it another way, which is to say you only want to work with financial professionals who work with the software package that you built your business around.
Yeah, absolutely right. Yeah, and I think it's important to think through, how to do this. We have a lot of people who, in our consulting practice, have become very, very comfortable with, client. I don't, or sorry, an intermediary person. I don't think I'll say who he is, or I'm not going to promote him during this episode, but I would just say that he's a contractor who's very, very good at books, and he takes on clients. And so you can find someone like that who can be a real person sorting this out at scale for you. I think it's critical as you grow. I don't think when you start you need that person, but I think after you get into the seven-figure range of selling, you're going to want somebody who systematically closes your books and does your P&L statement for you, so that it's just not on your plate.
Mm.
And every month you've got your documents that you can look at and review, and then they do special projects frequently as well. And I think that's a key part of the staffing component of this. Generally, I've found that is not your local CPA or local bookkeeper who just knows how to do small business.
Yeah,
I think it's a specialist role. I think you find that person online these days. I think
yeah,
frequently they have big six accounting firm experience or background. I think they can be an international contractor abroad, India, Philippines, somewhere like that, Eastern Europe, and they know what they're doing in an incredibly efficient way to manage, the process of reporting. And it's really like a de facto ghost CFO almost. The CFO has controls and responsibility, so it's not really that level, but it's someone who has the sophistication to put that level of reporting together, I guess, is
Yeah.
how I describe it.
Yeah, I think you're right. Now, what's interesting to me is a couple of things around that. What we're talking about is constructing the accounts accurately. Now, that isn't using them or understanding them yet. That's a different thing
Yeah,
again.
it's
I
just
would
getting
say
the
this
numbers. Yeah,
exactly, just getting the numbers right. However, just getting the numbers is properly the job, I think, of an accountant to set the system up and a bookkeeper to run it. But I do think you're implying, you do need a bookkeeper who's fairly expert and understands your system and your industry, unless you are yourself very on top of it, in which case you can put more SOPs and more training in, you can get lower grade workers. But I would always caution people, as I think we're both on the same page with this, I would caution you at getting very inexpert people in to do your bookkeeping just because they're cheap.
Yeah.
Just because you've been doing it yourself and you're cheapskate, the numbers are so absolutely critical. You wouldn't outsource building like a BMW or a Mercedes high-end German car and then outsource the making the light bulbs for the headlamps, which are a critical component. And then give it to some guy down the road just because he knows how to put a torch battery together. That's not good enough. You will crash if you do that. And I think it's too important.
Love it.
Talking about the headlights, I guess the best analogy I can give, if we're talking car metaphors today, that which I seem to be for some reason, trying to make this stuff concrete and real, I guess, is that it's all very well having accurate accounting for where you're at now, but if you're growing and you're growing fast, it's really, really important to project forward, not just profit and loss, which is a nice comforting idea, projecting how much profit you're going to make, but your cash flow projections. Because my experience with that in e-commerce, particularly if you're importing from China, and especially if you're selling on Amazon, which can have really incredible selling spikes, is that your cash flow probably spikes up and down way more than you would intuitively think it does. And particularly if you're having to put a load of orders in August for Christmas, and then you have your post-Christmas sales come in January, then you'll find massive spikes downwards in August and massive spikes upwards in January if you happen to be a Q4-centered, gift-centered seller.
Yeah.
But even if you aren't, I think it's really, really important to do a cash flow projection. Even if you just start with a quarter by quarter, the big businesses, I know when I say big, I mean they're scaling from 7 to 8 figures, they tend to have a 3-year, 5-year, or even a 10-year cash flow projection. Now, they generally have a CFO at that point, but even if you start off small, it's way better than nothing. And I think driving without a cash flow projection is driving blind at night without your lights on. I think it's incredibly dangerous, personally.
Yeah, no, I love this. I mean, this really transcends, I guess, what we've done in this first, few minutes of the podcast is talked about going from entry level, brand new, where you're just trying to keep your checking account balance above zero, to the point at which you've got velocity of sales occurring, and that creates different set of problems and challenges. And cash flow management or projection, creating your future, information. They call it pro forma work. Your next year's cash flow statement or profit and loss statement, et cetera, et cetera. That becomes critical tools for understanding what you need to prepare for if you have to finance things or whatever, related to just planning. And so I think that's fantastic. Okay, so I think we've gotten the first issue nailed. So what's the second general problem or concern related to cash flow management that you see?
So it's about low profits. Now, often a profit and loss focused operators, as you have been implying quite correctly, that one should start off at least that way, will see the problem as a profit problem. And that it is very true. But I think there's a more profound problem, which is a cash flow problem. If you have low profits, you have low cash flow. Low profits will make your business less valuable, and it means you're not allowed to take dividends out, because dividends have to come out of profits. You're not legally allowed, at least in the UK system, to take them out. But low cash flow, for me, is much more dangerous. That is basically how businesses die, because low cash flow could lead to not being able to meet your bills as they fall due, and that's technically bankruptcy, game over. So for me, low profits is a bigger problem than just not being a valuable business today or being able to take money out today. Low profits leads to low cash flow, so it's incredibly important to address it. And really, the solution is obviously to maximize your profits. And I think there's a wonderful book called Stark Naked Numbers by Jason Andrew, who I think lives and works in the US, but was originally from the Australia, so he's got that slight bluntness that I quite like, and Brits quite like sometimes in Australians, and he's a CPA and a very smart guy. But there are 4 what he calls profit levers, and I'm going to give them in order of priority, which is not necessarily the order that people normally do them. Normally what people want to do is increase unit sales. And on Amazon, the temptation is to drop the price and go heavy on advertising. That's not going to get you extra profits very easily. It may do, but it's not the best way. The best way is to increase pricing. That really hugely impacts profit. It's obviously hard, and we can discuss how to do that. The second one is lowering direct costs, obviously really critical. If you can go back to your supplier and renegotiate. The third thing is increasing unit sales. So at some point that comes in. And the fourth thing is to lower your overhead, which if you're a relatively small business won't have a big impact. If you're really big, that may be a doable thing. Companies tend to reach for lowering overhead, otherwise known in lots of euphemisms, which as an former HR professional, you will have learned to love, aka hate, which is things like restructuring. But it's actually the least effective way of increasing profits, according to Jason Andrew, who knows his business. So those are the 4 profit levers: increase pricing, lower direct costs, increase unit sales, lower overhead.
Wow. Okay. I think I'm a little bit lost, to be completely candid.
Please. Please be candid, and I will try and explain.
Low profits don't lead to low cash flow, in my experience. What I see frequently happen is people who have huge cash flow and no profit.
Interesting.
So
Tell me more.
they have, well, sure, they're 7-figure sellers that don't make any money.
Mm-hmm.
They're 8-figure sellers who go bankrupt. So the velocity of sales to me has never been attached to profits, and so maybe that's the terminology we should clarify. I say to people frequently in my consulting practice, you don't have a sales problem, because they don't need that. A lot of small business sellers, especially people who are kind of in growth mode, they're constantly focused on increasing their top line, just sales. To your phrase, cash flow. That is not the exercise. The exercise is retaining profit, and so I frequently ask people to stop focusing on their top line growth and to start focusing on optimization for net profit. And the change can be striking. I mean, you can literally have somebody who, let's just say they have $100,000 a month in sales and are literally not paying themselves a owner's draw, or don't have money they're taking out of their business because they feel like they can't afford it. And within a month or two, you can have them have just a bounty of cash flow, of net profit that they retain. And so I guess that's where just your first phrase maybe tripped me up, but low profits, I completely agree with, is a problem. And so I don't know if that makes any sense, but let's revisit your 4 now, just to frame it in my mind properly, or maybe I've confused myself. I don't know.
I don't know, but it's a very, very important topic to discuss, and I'm sure that there are many things I say that I think are clear in my head and on the outside, which is why a discussion-based podcast is so much better than just talking to a camera, because you got some feedback immediately, like, Mike, that did make sense. So let me put it another way. What's interesting is that it seems to be emerging that we have slightly different sort of obsessions, if you like, and you're very, very profit-focused, and obviously aware of cash flow. You're a super smart, educated guy with an MBA, but your focus is profit. For some reason, I'm maybe going too far in the direction of focusing on cash flow, but they are all important. Please do not misunderstand that I would never say it doesn't matter if you don't make a profit. That would be an insane thing to do, because you would be working really hard for no good reason. You wouldn't be building value or paying yourself. Right. So, however, what I suppose I'm pointing out is not in either or, but both and. Low profits may not be the reason for bad cash flow or vice versa. However, often a reason behind bad cash flow is that you're simply not making a profit, and eventually that will show up in the cash flow. It takes a while.
Oh, okay. Yeah.
So let me put it this way: it's not these are 4 levers you can pull to maximize profits, which may or may not also impact your cash flow in a way that's necessary. So the 4 levers are increasing pricing, which all things being equal, obviously, if you sell something for
Mm-hmm.
$25 and you used to sell it for 20 and your costs were 18, you've massively
Your
increased your
margin
profits.
expanded. Sure. Yeah.
Exactly. Lower direct costs. If you sell at $20 and your costs were $18 per unit total, and you bring it down to 15, you've again more than doubled your profit.
That's interesting because when I think of lower direct costs, I think of all the non-cost of goods related expenses in a business. The biggest one that I see people just literally take piles of money and light them on fire is in Facebook advertising.
Yeah, correct.
You can just turn on a literal fire hydrant of cash it does nothing for you
Yes.
in advertising. You can do it on Facebook and you can do it on Google as well. But
Yeah.
I frequently see operators who have just streams of ongoing expense dollars flowing out through the I'm advertising, line. Then are like, whoa, wait, how much are you spending? So anyway, but I take your point. Cost of goods associated expenses are important as well.
Absolutely. I mean, let's put it in simple terms. If you're buying a widget for $5 and selling it for 20, if you can buy it for 4, that extra dollar falls to your bottom line. Let's not be over complex about it. But it's also, to the point of the cash flow management, since that's what we're focused on today, also increases the positive cash flow of your business, which means, it's not that profits aren't important, they're critical. But also if you have cash, then that will enable you to actually buy new stock next time, whereas profits are theoretical until the point where you actually get paid, right? I would just say.
Sure.
And also to your point about advertising, 100%, I've personally seen that myself, some insane things with advertising, particularly off Amazon advertising, which is not in realms where people are automatically geared to buying products, so the conversion rate can be hellishly low, and Facebook ads can be horrendous. I would probably call that an advertising overhead. I mean, is it a direct cost? You can argue these things.
I see what you're doing, or he's done in this list, which is the lower direct cost is in reference to product costs. And
basically,
then his overhead phrase for his last one, finally lower overhead, is related to all things non-product. Yeah, I get it.
So. Yeah, you could put it that way. And listen, the whole thing of like direct versus indirect costs can end up being one of those how many angels dance to the head of a pin discussions. Sure. And it's very important that you and your accountant understand what you mean by these things, and that you have the same common language, and the same if you want to bring external investors in, that they understand what you mean by it. But in the end, you just have to clarify it for your own particular business. Where you put those lines varies between e-commerce operators. I know, for example, that with advertising, sometimes that's seen as a direct cost. Some people put it as an overhead. So anyway, hopefully that makes sense.
It does. I mean, it's a good list. I'll just say that increased unit sales is on that list. And I will just say that increasing unit sales only helps maximize profit if it's unit sales that are in line with your margin, and that have, because so for example, we had a good solid 6-figure revenue stream that over a couple year period we just did the math on and realized there is no money in this.
Yeah, absolutely.
And so when we eliminated that revenue stream and all those unit sales, in essence they were unit sales, and all the associated income from that, or money from that, our business net profit went up.
Yeah.
And so we lowered our top line number and increased our net profit.
Yeah.
And so I think there's important analysis to be done, and it goes back to your first point, which is knowing your numbers. And if you have a stream of products, 2, 3, 4, 5, 6 products, then optimizing net profit is an exercise in optimizing the revenue from those different types of products. So I think there's nuance there. Yeah.
There is. I mean, and I guess I've tried to keep it simple, but maybe I've oversimplified it. What I should say, of course, is if you want to maximize your profits, you need to increase profitable unit sales rather than unit sales of things that aren't profitable, which is a very good point that you've just put your finger on, which is that a lot of products, if you do an analysis, an 80-20 rule of applied to your products, and you look at what products produce what profit, what percentage of your profit, not revenue, profit. And you always have to say the number twice, because people don't automatically think about profit, as you, to your point, absolutely right. They think in terms of revenue. If you look at 100 products, you may find that 20 of them produce 120% of your profit, which sounds like a maths error, until you realize that what that means is 80% of them are losing you money, to your point, which is very true.
Yeah. Okay. Love it. Great. So that was the second problem. So the third big cash flow issue or problem is what?
Not enough cash, or that you could say that's where it shows up, and I would say it's an underlying cash flow management issue potentially.
Okay.
So I think the solution to this is, I mean, not to ignore the previous two things. If you don't know your numbers, you have no idea. You can't solve it really.
Yeah.
If your profits are horrible, or you're basically trading at no profit or even at a loss, then that is part of the underlying root cause.
Okay.
But aside from those things,
Yeah.
it's around your cash conversion cycle. And one of the solutions that is being practiced by people from anyone from Hewlett Packard to Amazon is to change their cash conversion cycle, and that changes everything about the business.
Okay.
So
So
broadly speaking,
talk to me about, what does that phrase mean? What's the cash conversion cycle?
cash conversion cycle is basically you turn cash into, so for a typical e-commerce business, you turn cash into stock. So for example, if I'm ordering stuff from China, let's say it's beginning of April, I put a deposit down and say $3,000 for a set of stock. I wait until it's been manufactured, let's say the 1st of May or something, that I would pay the remaining $7,000, and then the stock would land in Amazon or in the US, and then go into my own warehouse or Amazon or wherever it's being sold from in, say, what are we into, July? And then that would sell through, let's hope, over about 3 months. So that's really when the cash conversion cycle is completed for that particular set of cash.
So by October, then you've got cash again.
Yeah, and hopefully, obviously, if it's been profitable, then it's cash with friends. So you've turned $10,000 into, say, 15,000 or whatever your return on investment is. If it's sold at break even, then it will just bring you 10,000 back out.
So it's so fascinating. Just as a digital goods seller, we have a catalog that has no cash flow cycle that's equivalent to what you just described.
Very interesting.
We have work involved in making the product, one-time fee for expense or time, and then beyond that, it's just obviously near zero marginal cost and instant, turnaround. So it's a different model. So talk to us more about that then. What are the challenges of managing the cash flow cycle? How do you shorten it, et cetera, et cetera?
Yeah, so shortening it really comes down to, I think, three things. One of which is the biggest strategy. I'll probably come to that last because it's a little bit more sort of bigger picture. But the two sides of it are really increasing the money you owe people and then decreasing the money that people owe you. Which sounds a really weird thing to say. So let me just talk about this. So accounts payable basically means the money you owe other people. And broadly speaking, from the cash flow perspective, this is why there's a difference between a balance sheet and the cash flow, and why I think all three statements are important, i.e. profit and loss, balance sheet, cash flow. This is effectively cash flow management. Because from the profit and loss point of view, this doesn't change the profit and loss. But from the cash flow point of view, it changes everything, right? So here's the thing. If I buy those same widgets from China, let's say that I'm buying $30,000 worth, because you won't get it for small deals. And I need to, with the first structure, I'm buying, what do I say? Let's say I'm buying $100,000 worth of product from China.
Okay.
And in my original deal, I'd put down a 30% deposit, and then when it's made, I pay them 70% balance. Now, if instead of paying them $30,000 in April and then paying $70,000 in May, I can get a deal with them where I pay them $30,000 in May, and then I pay the rest when the boat lands in the USA. That means a heck of a lot less cash is tied up. So my working capital, which is really a function of how much you owe and how much people owe you, is much smaller, which either means you can grow a lot faster with the same amount of money, or you need less money to make the same amount of sales. And it's a profound difference. So this is one of those things where getting great supplier credit deals is absolutely critical. If you get it import from China, particularly, which many of us do, or from any other, India, same thing, or from Europe to the US for that matter. This is one of those things where the serious businesses that I know really, really work on this, and it makes a massive difference to the amount they can grow in any given year, or the amount of money that is needed to be invested in their business.
And do they usually work on that through the strategy of better terms from the supplier, or do they get funding, loan products, that kind of thing for financing the inventory?
Well, there are
handle this?
lots of different approaches to it, and you can get into the weeds on this. The very best and the first place to try is always supplier credit. And the
Uh-huh.
good thing about the Chinese particular is that because they're effectively most, and this is why the US and Chinese governments get into hot water politically. But the truth is that the Communist Party seems to be behind funding most stuff ultimately in China. Therefore, there is pretty, at the moment, and there has been for a long time, pretty liberal credit available to suppliers, which they then often pass on to the people like ourselves that are buying, basically because the Chinese sort of, I suppose, trade policy for a couple of decades has been market share grabbing, and therefore they've been funding it like absolutely crazy. Now, does that party stop at some point? Probably, if you believe people like Peter Zion and so forth. But for the moment, it seems to be very true, particularly now. So often, what a supplier is interested in is order size, and that's pretty much it. They don't seem that bothered about profit. They get a little bit of a rebate from the Chinese government, but they really don't care that much about cash flow either once you've really established you're a big player, which is amazing because we really need to care about cash flow if you're a small business owner of a business that grows rapidly. So that is the best possible solution. I mean, yes, you can look at factoring, which is really, I would say, accounts receivable management, which is the second part of the
And
piece.
explain what factoring is for people who aren't familiar with that phrase.
Yeah, so I'm going to think there are a few different possibilities. The one that I'm familiar with is that basically they would what they call a receivables purchase. So they would look at what Amazon's paid you for the last year and say, okay, we think that Amazon over the next 6 months or the next 12 months or whatever it is going to pay you X amount, say $200,000 or something. So we will pay you that money now, and then when Amazon pays you, you pay us, and we'll take our cut at that point.
So it's a loan against your accounts receivable.
Kind of. Technically speaking, it's not a loan. In essence, yes. For you and me, it is. For the people who do it, it's not a loan, and they're not allowed to call it that, and the SEC gets involved. But yes, basically, yeah, it's something like a loan, basically.
Okay. It's a commitment. You owe people money based on your future cash, accounts receivable. Yeah,
that's right. Yeah. So that's something that's less attractive, but also possibly less necessary, because the other side of your cash flow conversion cycle is, but if I sell stuff on Amazon, I get paid 14 days later. If you sell on other marketplaces, by the way, it might even be even later.
Instantly, sometimes.
Yes, could be instant.
If it's digital.
Yeah, if it's digital, yeah. Yeah, so obviously, one reason to sell digital goods, by the way, is the whole characteristics of the cash flow, which is a different thing from the profit and loss, although related, of course. All these things interact. But that brings me to the third overall point, which is your overall stock or sourcing strategy viewed through the lens of reducing your cash conversion cycle is important. For example, very simple but very profound, is if you source stuff in the UK and sell in the UK, as one of my clients in the 10K Collective does, the cash flow characteristics of his business are profoundly different and much, much better than most people who are importing from China and selling in the UK. How? So, for example, if you need to buy enough stock to sell such that you don't go out of stock, right, which is the fundamental thing, then if you can buy 6 weeks stock and then ship it into Amazon, and it goes from factory order into Amazon within, say, a month. So all you need to have is 6 weeks worth of stock tied up in, cash tied up in stock, rather than 3 or 4 months.
So it's the speed of from manufacturer into Amazon FBA warehouse.
Exactly.
Okay.
That's the practical thing, but what that does to the cash flow is it means you tie up a lot less cash. You tie up maybe a month, maybe 6 weeks cash as opposed to 3 months. So again, it kind of halves or is a third less working capital needed compared to somebody who's importing, which is a profound change.
Okay, so ideally you'd be sourcing product from some manufacturer who has their warehouses about, 1.5 miles from Amazon warehouses or something like that.
Yeah, I mean, they have multiple warehouses, so that would be, but it's something, ideally, you're absolutely right. The ideal manufacturer basically lives a stone's throw away from the warehouses you're going to use for fulfillment, even if it's your own garage or something, and they have a really short manufacturing lead time. Absolutely right. Okay. So, yeah. Right. And those things may seem just like a pain to manage, and from the profit and loss point of view, they affect it, of course, but from the cash flow and the working capital requirement, they are profound. And that is really all of this we're talking about now is technically, I would call it balance sheet management, because technically it doesn't show up on the profit and loss because it doesn't change the value of the equity in your company, but it really, really shows up in the cash flow, like big time.
No, totally get that and agree 100%. And so when you talk about that, balance sheet management, you've used the phrase working capital. Talk to us about what that phrase specifically means. And I see entry level e-commerce sellers who struggle with this whole question of scaling their expenses associated with inventory and not understanding how to pay themselves. It's like, it's just, and they call it feeding the beast. And it's all about reinvesting all your money into inventory, especially for arbitrage people who are trying to figure out how to scale arbitrage strategies. They're in this difficult position where they want to grow their business, but at some and they can if they continue to invest all their money into inventory. But at some point you say to yourself, I'm not being paid for any of this work. So how do you manage working capital and get to clarity on those types of issues?
Well, it's a very good point. I mean, I think the general point is probably the most important, which is that simple phrase that everyone needs to burn into their brains, which is growth sucks cash. So as one of I interviewed a guy the other day from Thrasio, which is a huge monster that's aggregator that's gone from $1 billion valuation to about 6 now over a few months. And so they employ some very smart people. And this guy's also an Amazon seller, and I've known him for years. Really smart guy. So he was an operator in the trenches like ourselves. And basically he said this, that Amazon as a whole, on average, grew about 38% in 2020. Now, it was an extreme year. I'm not predicting that will happen again. But he said this, first of all, if you've got a 30% profit margin, then you haven't even got enough cash to fund the growth. So you not only will you not be able to pay yourself if you're growing at the rate that keeps you in pace with Amazon. I'm not saying you should, but if you did, which a lot of people would choose to, then you haven't even got enough to pay yourself, never mind actually, and fund growth. So I think you really have to choose, if you're going to take one pot of cash and try and allocate it to 2 uses, then obviously it doesn't work. It's like, I can't borrow the car on the calendar and then also lend it to my wife at the same time and both expect to use it.
That's part of the answer, is bifurcating your inventory, cash or planning money.
Yes.
And your other business expense money, including paying yourself.
Exactly right. Yeah.
2 different buckets. Yeah.
Exactly right. So if you want to grow at 30% and your profit margin overall is about 30%, then you haven't got anything to pay yourself with. So you either need to grow slower and pay yourself, or you need to get funding. And I would suggest, weirdly enough, although I would never say that getting external money, whether it's in the form of debt or factoring or even investments, it's never an easy or quick or simple decision. But nevertheless, if you do want to consider not growing and paying yourself, that sounds attractive and responsible if you take your business in isolation, but it does not exist in isolation. And if the markets around you are being funded by billions and billions, probably going to be trillions of dollars soon of cash from private equity investors who are now coming in, as well as the venture capitalists, then that means the market as a whole is getting full of well-funded smart operators. I don't think in an environment like that it makes sense to be too abstemious on growing your business. And I think you need to make a decision about what you're going to do in that environment,
Yeah, it's so tough though. And this is why entrepreneurship is difficult, because I hate going fast and blowing things up on accident. I would advise people every day of the week, go slow and build your business methodically. And if that means you run into a product category where you lose because you didn't scale along with the competitors, then lose. Yeah. But do not ruin your future opportunities by trying to scale something too fast. I mean, it took us like 5 years of kitchen table entrepreneur before I could leave my day job.
Sure.
And, I don't want to worry for people, but I would just say it's better to go slow and build methodically and really understand the market dynamics and be in the game than be a non-survivor. Because, like, there's a great phrase in mutual fund investing called survivorship bias. Yeah. It's like, hey, every mutual fund earns 8%. Yes, that's true, except for all the ones that blew up and went out of business.
Listen, I couldn't agree more. Here's what I would say, though. You have to be real about the relationship with the dynamic of what you want internally in your business. And I absolutely agree with you, by the way, Jason. Please understand that. I'm absolutely not in favor of ridiculous growth. I would say 2 things. Number one, if you have chosen to sell whatever it is, iPhone stands on Amazon, you're in a business model. That means you have to grow aggressively or get out. And you have not chosen well if you want to have a less aggressive business now. I agree that therefore it's probably not a good plan for most people, right? But if you are in that, you're going to have some choices to make now because there's very big money coming in. They'll be doing the incredibly optimized images. They won't need to worry. These guys who are investing billions will not be looking for a cash return for a couple of years. They're interested in market share, and it's like Amazon on steroids. So that's the first thing. I mean, you've got to just pick your fight. And I think to your point,
what we're clarifying together is cash flow is a function of your business model, and your business model is not your business. You can be in business and say, you know what, this business model really stinks.
Yes,
I'm winding this thing down, and I'm going to scale up a new business model. And your cash flow will change accordingly. And and you can blend down one, dial down one business model that has one cash flow dynamic and dial up a new one that has a different cash flow dynamic. And neither of those were your business. Your business is you running, an e-commerce operation or, a small business, and you get to choose. What do you, how do you do that with different business models? And I guess that's what we're trying to clarify here. So anyway,
that's very, very good point. You made a really superb point there, because here's the thing. If you don't have an appetite for risk, or you probably rightly, to your point, and I really agree, that you shouldn't be taking big risks and risk, as Warren Buffett says, you've risked losing 100 million this year in order to be worth 110 million next year. Why is that a good trade? I totally get that. In which case you're absolutely right. If you're selling on Amazon, you may well be thinking, I need to be spooling up my Shopify site pretty fast in order to be in a space where things move a bit slower and I can run it at a pace where I can take some profit off the table each and every year and take my family on holiday and have the odd day off. You're absolutely right, and thank you for clarifying that, because that's clarifying my own thinking as well. You're right. Business model links with cash flow characteristics, and business model is not business. Really, really good distinction. The other thing I was going to say, though, is this: if one is more inclined to be more aggressive, and I've worked with people who love the aggressive, growth that you can get on Amazon. Here's what I would say. The more aggressive you want to be, the better you need to be at the skill sets that we've been discussing today, which is to say that you need to really know your numbers. You really need to do cash flow projections, like years ahead. You have to scenario planning, best case, worst case, and a sort of average case. You really need to be conscious of and working on your profit levers. So having a strategy for increasing pricing, which I would say, broadly speaking, in a nutshell, have an amazing brand and have incredible photography on your site. And you need to be very, very smart at managing your cash flow. So that the more, your balance sheet management that we talked about. So I think that's the other thing I would say.
Yeah, this conversation is helping me clarify. With cash flow, it is the same as a game, and the game is there's two ways to play. One way is to play to win. The other way to play is to not lose and to be unbeatable. And so I guess in my mindset, I've always been the guy who I'll play defense way harder than I play offense. And that goes back to American football, I guess, when I was growing up. But I always that if you cannot be beaten, then you're in the game. And so for cash flow, I'd rather use strategies that make me unbeatable than make me win. And so I think there's a difference in entrepreneurial spirit or style there that's very core to who you are and what you're all about psychologically. And so I think cash flow is at the root of all of that, though, isn't it? I mean, it plays into that, whether you're going to play the cash flow game to beat, all your competitors on Amazon, or if you're going to use the cash flow game to not die, not be beaten, not be taken out by a mistake of your own making or other people's,
I agree entirely. And by the way, I'm kind of with you on the defensive move. I think some of the smartest business people I know, actually, for example, Richard Branson, famous UK entrepreneur, he's actually nothing like as risk on as people make out. He looks into the risks before he does anything, and he does smart deals. For example, when he started one of his Virgin Airlines, I forget which one now, but maybe it's Atlantic or whatever it is, he leased some planes from Boeing on the understanding that if it didn't work, they'd take them back. That's a very smart thing to de-risk. So we talked about risk management and risk reward analysis. What I would say about this, just to not lose the wood for the trees, is whilst maybe some of the stuff I've been saying sounds like I'm pushing people to do really aggressive stuff, I'm not really. I think that all three things, like knowing your numbers, maximizing profits, and shortening your cash conversion cycle, whether it's in an aggressive or a more defensive way, are all core approaches that will work for a defensive or a really aggressive business.
Totally
Is the only
agree.
thing I would say.
Yeah, love it. And so that's really a good summary, isn't it? Why don't you just walk us through again those three things as a summation of this conversation, and then we'll wrap it up.
Sure. So the first thing is, if you don't know your numbers, you're driving blind. And by the way, to the point of being defensive, that's incredibly dangerous. That is not a way to keep operating. Even if you're doing low six figures, I would argue that it's not a good way of, it's not a base for expansion, whether slow or quick. So the solution is know your numbers. So make sure you got a chart of accounts. That links the journal of actual transactions to your QuickBooks or Xero. I would use not only software like Link My Books, for example, from Amazon to QuickBooks or Xero or A2X, but I would make sure, as you said, get a really good quality bookkeeper in place. And again, I would do this earlier than you think, to be honest. Like a low six figures, already you need to be doing it, in my opinion. And I think creating cash flow projections, again, I think you need to do this earlier than you think. But if you're, moving slower, you can afford to do quarterly cash flow projections. The faster you move, the further you need to look ahead. Just like if you're driving very fast at night, you need to have real powerful full beam headlights on, in which case you need to be looking at a 1, even 3-year cash flow projection. The second thing is maximizing profits. You've got 4 profit levers, which is increasing pricing, lowering direct costs, increasing unit sales, but only, as you pointed out, if they're profitable sales, and lastly, lowering overhead. And then the other thing is shortening your cash conversion cycle. First of all, basically paying your suppliers or paying anybody later, so increasing your accounts payable, so pay as late as you can. Getting paid earlier if you want to, accounts receivable management, which varies in how important it is. And then also think about your overall business model, which, as you pointed out, has cash flow kind of characteristics, and thinking particularly if you're sourcing physical products about the cycle of how early you need to pay and how quickly you're going to turn that stock back into cash.
Love it. Okay. If you've liked this episode, then be sure to check out Michael's coaching work on the AmazonMastermind.com. And you can also check out my latest book, E-Commerce Power. And links are in the show notes, of course. And as always, it's been an honor to have a great conversation with you today, Michael. Thank you so much for breaking down cash flow for us. Hopefully everybody's gotten a lot of value out of this. If you have, we'd love your highest and best review on Apple podcast player or Spotify or whatever your player of choice is. And be sure to refer a friend. And if they're struggling with cash flow in their business, of course, we'd love to have you share this episode with them. So thanks so much, Michael.
Thanks, man. Great conversation.
And we're out. Okay, that's the end of our podcast. Okay, good stuff, buddy.
Yeah, very interesting discussion about the whole profits sort of and how profits and cash flow kind of interact. It's as you said, there's more of a mindset component to this than you might think up front, right? It's interesting.
Yeah, love it.
But very interesting stuff.
Well, thank you for hanging out with us today. Really, really appreciate the support for the podcast. It continues to grow in sales, in subscribers and downloads, and it is the #1 podcast for e-commerce in Spotify, and that's an honor. And so continue to go back through the episodes we've done previously. Now we're a good number. I don't even know how many episodes we have in the vault, but it's gotten into, it would be a couple years worth of content now. So
it has, yeah. It's just grown, and hopefully, I think I'm quite proud of the content we got out there. Having produced a lot of e-commerce episodes, which I kind of grown slightly to think that they're probably useful, but hyper specific and not very engaging. I mean, for me personally, this is where it's at. I'm becoming more and more of a believer that the strategic level questions, if you answer them correctly, then everything else can flow from there. So totally. Macro to micro, that's my mantra.
Yeah, love it. All right, buddy. Good times. Thanks everybody for hanging out with us, and we'll end it here.